Welcome back. My name is Sev. I'm from Hunter and Chavi Investments. I hope everybody's staying safe and healthy during this whole COVID-19 thing. But with mortgages being on hold as far as getting a foreclosure or anything like that, it's to benefit some people that aren't able to make their payments because of unemployment. But for me, unfortunately for me, my loan is actually a private loan, so it wouldn't be qualifying for as far as a government loan or a Fannie Mae. But today I wanted to talk about private mortgage insurance because the way I can reduce my monthly payments for my mortgage was to reduce or even eliminate my private mortgage insurance. So let me start that off. If you haven't already, subscribe to my channel, like, comment, share, subscribe. So that keeps me going. And hopefully in the future, I might be doing a show called Financial Fridays. So that's coming up in the works. But let me share my screen. Right there. I'm going to share. Yeah. Hopefully you guys can see that. I'll move myself around here. All right, so private mortgage insurance. What is private mortgage insurance? So what it is there's two kinds of insurance that you need when you purchase a home. Usually home insurance, also known as hazard insurance. And I'll put this in disclaimer. I am not a financial advisor. This is my personal experience that I have done. And unfortunately, you'll learn from my mistakes is what I've done. And I'll ask you later for any comments or any advice that I can take from you guys, because it's like I said, I'm not a financial advisor. This is just my experience, my case study I'm presenting to you. So that's my disclaimer. So private mortgage insurance, what it is it protects the mortgage lender. So with the whole recession 2008, the whole mortgage crisis, the insurance kind of protects the borrower rather than the lender, not the borrower. So that's one insurance. And then you have a second insurance called hazard insurance or private property insurance. So it protects your property that you own. So you need two, unless you put down a significant payment of 20% of the value of the house. Let's say a house is worth $100,000 and you put down, $20,000. So now you have $80,000. So you have 20% equity in the house. Equity means you have interest in that property now because you own 20% of it or paid down the principal. So private mortgage insurance, let's go back. This is real numbers. This is my numbers. And you shouldn't do that. You're being too transparent. I'm putting my information out there. This is so I can help somebody else out there. This is a real case study and it's actually about me. So private insurance. So as I stated here, private PMI, private mortgage insurance. Mine's $257.99 per month. If you do the math, that's about $3,995, $3,095.88 per year. So I'll fix this in live time here, times 12 months. So you have 3,000, or for an average, I put 5 because an average mortgage takes amortized would be about 5 years, so about 5 to 7 years. And that puts me in about 5 years, I've given them $15,479 for no reason. That's why I'm so adamant trying to get rid of this, because it's actually benefiting the lender. It doesn't benefit me at all. It's just an extra $257 a month that I could be making toward a car or something like that, something more enjoyable than paying mortgage insurance. So my balance at that time, this was around February of the beginning of the year, so February 2019. So my balance is $43923.44, and I'll just round down just for make it simple. And I got an appraisal of 506. So you need a loan to ratio. That's what I talked about earlier, of 80% or less, as far as like what you owe. So loan to ratio, so is what you owe to what the value of the home is. And it's based on market value. So your market somewhere else in California, Georgia, or Nebraska might be different from Northeast. So loan to value, my loan was $43923 at the time. I just rounded it down. and then I appraised at 506. And then that puts me at 7.7982. You multiply that times 100 because you want to get percentage. So your percentage came up to 79.82. You would think that's perfect, right? It qualifies perfect. But my lender, the private lender I'm with, I'm not going to mention their name, but I failed to realize that they needed a new LTV or loan to value ratio of 75% or less. So you would need the house to appraise at 535, or even pay this down, the principal, to get up to 75% or less of their new criteria for LTV. So it cost me some money. There was two options they gave me. Well, actually three. I didn't list it here. I'll put the third one here. Let it drop to 20%. So you guys are getting this real live right here. So three options. Option one was get a PPO, a broker's price opinion. What basically that means, they got a broker, or not a realtor, a broker that's out there that'll look at the property as far as tax records and market value, and they'll give you their opinion, so broker's price opinion. So basically they're just shooting out this document saying this is what they think how much the house is worth, but then never seen the house. They'll look at the pictures, but they won't never seen. What I got was the actual appraisal, where actually the person came out to the house, took pictures, reassessed the house, and if you look back at my other clips of videos, I installed my solar panel, so that helped. I purchased my solar panel. It was costly, around $35,000-$40,000, but the value went up to my house because I did that, because I actually owned the solar panels. So that's another video that you can look back at, the first two videos I did on that one, and actually get paid for that every month, every quarter. I apologize. So I paid for the appraisal. For a single family home, this was $325. So I took the chance. I said, you know what, for the $150 and the $325, that's about the same as I would pay for a monthly PMI. So I took the chance on it. And the third option is just let it drop to 20%. That takes about 5 years to amortize. So I didn't want to do that. I need this to be done quicker. So with the new LTV of 75% or less, you would need the house to appraise at 535, or pay down the principal here to 403 to get it 75%. So my question to you, because I'm not an expert, would the home equity line credit, where you take out, whatever you had appraised already? So I'm appraised, that's technically I own 20% of the house already, because it's appraised at 506. Should I take a HELOC out? I'm gonna ask you guys, the audience. Or should I just keep paying extra monthly payment to get that down? And that way I have some, easier way of getting rid of the PMI. That's it. That's just today's video clip, but I just wanted to make it because it has been a while since I made one. So hope you enjoyed. Hope you guys comment, subscribe, and then share this. I'll see you in the next one.